Good morning, or good afternoon, depending on where you are. My name is Marcus Noland. I am the Executive Vice President and Director of Studies at the Peterson Institute for International Economics in Washington, D.C. It is my distinct honor and pleasure to moderate this session on economic sanctions on Russia. We have three speakers, Jeff Schott, Elina Ribakova, and Stephen Fries, with distinct and complementary backgrounds and perspectives, which I anticipate will make for a highly informative session. Economic sanctions have a long and somewhat controversial history. Today, in the context of Russia's invasion of Ukraine, the stakes could not be higher. Sanctions against authoritarian regimes are particularly tricky. Those regimes can use the rents that sanctions create, either through shortages or opportunities for evasion, to steer benefits towards favored constituencies, ironically reinforcing political control even as the overall economic situation deteriorates. Russia may be an exemplar in this respect. Jeff Schott will set the stage. Jeff is one of the longest tenured senior fellows at the Peterson Institute for Economics. I think he's been here for about 40 years, working on trade, regional economic integration, and economic sanctions. He literally wrote the book on economic sanctions, co-authoring Sanctions, Economic Sanctions Reconsidered with Gary Huffbauer and a series of other co-authors. He will summarize the key points in his new policy brief, Economic Sanctions Against Russia, How Effective, How Durable, briefly discussing the impact of G7 sanctions on Russia and its ability to conduct conventional warfare, the limited scope for circumvention, how Russia is becoming more dependent on China, and lessons for deploying sanctions in the future against major countries. He will be followed by Elina Ribakova, one of our newest staff members. Elina is a non-resident senior fellow with PIIE, has affiliation with the Brussels-based think tank Bruegel, and is director of the International Affairs Program and vice president for foreign policy at the Kyiv School of Economics. Her remarks will address the impact of sanctions on the Russian economy, specifically looking at the impact on high-tech inputs, including the military, and the impact on Russian productivity and its potential economic growth. Stephen Fries is a non-resident senior fellow at PIIE and a senior associated fellow at the Institute for New Economic Thinking at the University of Oxford. He was previously chief economist at Shell and the UK Department of Energy and Climate Change and deputy chief economist at the European Bank for Reconstruction and Development. We are fortunate to have him here on one of his periodic visits to the mothership. Stephen is an expert on energy markets and oil more specifically. He will examine the impact of G7 EU sanctions on oil sanctions on Russia and the OPEC plus production cuts on the Russian economy and global markets more broadly, both now and looking towards the future. Each of the presenters will speak for about 10 to 12 minutes and then have an opportunity to react to the remarks of the others. I will then open it up to Q&A. Jeff, the floor is yours.
Thank you very much, Mark. And it's nice to be back at the podium here at the Peterson Institute. And this is a really important subject, so let me get right into it. Economic sanctions have long been an important tool of foreign policy, but I think the current sanctions against Russia pose unique challenges. This is the first time in the post-war era that comprehensive financial restrictions have been imposed on a nuclear power engaged in open warfare. The context is a lot different than past episodes of sanctions in the post-war era. And a power on which world markets were highly dependent for supplies of energy, food, and raw materials. That's why I think the G7 countries pulled some punches in deploying what they called severe sanctions against Russia, exempting for most of 2022 Russian energy exports so that Western consumers could avoid self-inflicted shortages, but not higher prices, and keeping open some financial channels to allow trade in some other products to continue. So let me start with the question that is always asked, and that is, are sanctions working? And of course, to answer that, you have to say to what is the goal? And sanctions have multiple goals. They fundamentally want to coerce policy change in the target country. They want to deter the target from additional aggressive acts. They want to punish the target for the deeds. And they want to demonstrate at home and abroad the resolve to confront military and other actions by the target country. That's a critical objective of sanctions that is important in sustaining public support for imposing sanctions against the target country and paying for the support of allies. Overall, sanctions haven't achieved all of their objectives, but they are having an impact on Russia and continue to be revised and augmented to work better. Certainly more needs to be done, and I'll propose more actions towards the end of my presentation. As Elina will discuss in more detail, the Russian economy is not growing, but has not been defunded by the broad G7 sanctions and selective trade embargoes. Sanctions still permit sizable and profitable Russian energy exports, and taxes on energy production and trade accounted for almost half of 2022 federal government revenues. Spikes in commodity prices, coupled with sanctions-related compression of Russian imports, generated a record current account surplus in 2022. But sanctions have caused a sharp compression in Russian imports, limiting access and raising costs of imported technologies and inputs for the military-industrial complex. It's made it harder to retain and attract, it's made it harder for Russia to retain and attract foreign investment, and has slowly begun to squeeze Russian government finances. Now, are sanctions being circumvented? That's the second question that is always asked. And the answer is, no sanctions regime is airtight. So yes, some goods are avoiding the sanctions net, but relatively not too much. And so the reports of goods streaming through Central Asia and the Middle East are undoubtedly, some are true, but the volumes involved are rather limited compared to the imports that Russia was able to buy in before the war started. For example, the value of Russia's imports from Turkey doubled in the second half of 2022, but that doubling amounted to sales to Russia of a little over $6 billion. And so rather small scale in terms of the size of the diversion of trade through countries or the circumvention of the sanctions. In terms of Russia's imports, China is the big story. Its sales to Russia rose to $76 billion in 2022 and now account for 36% of total Russian imports. But Chinese firms largely have avoided exports or investments in Russian projects that would run afoul of G7 sanctions. So there's a lot of consumer goods, but in terms of sanctions busting, China has kept a careful eye on staying onside on the G7 sanctions. In terms of Russia's exports, the big question is whether Russia is circumventing the G7 oil and oil product price caps introduced in December of 2022 and February of this year. These caps are designed to squeeze revenues flowing to the Russian government and military. So far, and Stephen will go into this in more detail, and I've drawn on his expertise in writing my paper, the EU embargo, by reducing demand and forcing exporters to incur substantially higher costs to ship oil to Asia, has hurt Russia more than the price caps themselves, which largely have not been binding to date. That is now changing as the oil market rebalances, but I will leave that to Stephen to give the insights into what is going on there. So to sum up so far, sanctions have contributed to a sharp compression of Russian imports, forced Russia's military and industry to source from more costly and inefficient suppliers, and slowly squeezed Russian government finances. Efforts to circumvent the sanctions have had only small-scale success. But the third question, can G7's support for sanctions be sustained? The corrosive effect of sanctions on the Russian economy assumes that G7 countries will continue to be willing to absorb the costs of both supporting Ukraine's economy and military and adjusting to the countermeasures introduced by Russia that have created more volatile energy and commodity markets that cost Western consumers and businesses. The watchword of the G7 officials, when asked about the durability of their commitment to supporting Ukraine, is that they say, we're in it for as long as it takes. But Russian President Vladimir Putin seems to be counting on sanctions fatigue, already evident in some factions of US politics. To further counter Russian aggression, the G7 needs to ratchet up the sanctions, transferring Central Bank of Russia reserves already frozen into escrow funds to cover judgments against the Russian state and support for Ukraine's reconstruction. This has been a controversial proposal since I put it forward and others over a year ago in an Institute blog. But I think it is gaining traction. And it's especially important because this would demonstrate to US and other G7 voters that their continuing support for Ukraine was being financed at least partially by Russian funds. And I think Europe, I think there is less fatigue in supporting Ukraine. It's a more existential problem for Europeans. In the Congress, you see glimmers of weakness, of weakening support for the support, and I think that needs to be bolstered, and this is one way of doing it. Now, there are geoeconomic consequences of the war and the sanctions. It's really too soon to tally the costs and consequences of the war and the sanctions, but let me just mention very quickly a few points. The war and sanctions have strengthened the G7 and NATO alliances and made them more resistant to sanctions fatigue, even though there are these pressures. That's exactly the opposite of what Putin thought he would do in starting his military aggression. They have made the Russian economy more autarkic and less productive. Weaponizing energy will have permanent and negative consequences for the Russian economy. Europe has already begun to accelerate its shift to renewables and other energy suppliers. China and India have become Russia's main oil customers, but they are unlikely to follow Germany's precedent and become overly dependent on Russian supplies. Russia's aggression against Ukraine has also incentivized the restructuring of supply chains to reduce reliance on Russia's supplies of farm goods, fertilizers, and raw materials. And finally, war and sanctions have driven Russia and Iran closer together. And Russia is becoming more dependent on China. If I were a Russian official, I wouldn't take great solace in either of those developments. So finally, as we do here at the Institute or have done for the past 40 years, we try to derive lessons for what this means for the use of sanctions going forward. And let me offer 3 quick lessons. First, big powers have the economic size and military power to deflect the immediate impact of sanctions, can impose countermeasures against those imposing sanctions against them, and have leverage via threat or bribe to attract support from third countries. We've seen Russia try to do that, and it's had some consequences. Using sanctions against big powers requires a long-term commitment to their implementation and enforcement. It requires coherent and coordinated policies among the G7 countries to maximize the impact and minimize leakage and evasion. And provision, and this is critical and will be a continuing issue for the United States in particular, provision of support or tax relief to those at home hurt by the G7 sanctions or countermeasures by the targeted big power. The European countries did this very effectively in 2022. Finally, thinking about sanctions against big powers in the future requires contingency planning for future scenarios against big powers, and that is an effort that should have started yesterday. Thank you very much.
Thank you so much for being here with us in person and online, and it's an honor to be following on Jeff and before Steve, so I have a perfect sandwich here. And I will use some of the sort of messages that Jeff has provided to expand on 3 points. One is, in detail, what has happened to Russian economy and why this last year? What are we expecting from the Russian economy over the medium term? And finally, maybe a little bit more specifically on the lessons within Jeff's broader framework, what can be done better and differently, how sanctions can be revised and augmented so that they continue to be effective. So first, what has happened and why? Let's just go back a little bit before the full-scale invasion of Russia on Ukraine. Russia was recovering very strongly post-COVID, was reopening. We had surprisingly strong numbers, and most analysts were expecting growth of 2.5% to 3.5% of GDP in 2022. So it was a rather positive outlook for Russian economy. According to Russian Rosstat numbers, and we can discuss them, the Russian economy has contracted by about 2% last year. So it is a contraction, significant reduction in Russia's growth compared to expectations, but also it is not such a sharp contraction that many were forecasting and hoping for last year. So why did that happen this way? So I think first, it is, of course, the sort of healthy post-COVID recovery, especially into the beginning of the year. But importantly, as also Jeff pointed out, and Steve, I'm sure, will expand upon, Russia received a lot in oil and gas revenues. So the way Russia taxes oil and gas sector is very straightforward. It has extraction tax, it has export tax, and also has much less straightforward excess profit tax. And all 3 of them contribute significantly to the federal budget and also even to consolidated budget, which is a little bit bigger. So the revenues increased, including all these 3 taxes. Because of the higher prices, only marginal reduction in exports and production, and actually the production remained more or less flat for the year as a whole, and also this excess profit tax, including a one-off tax on Gazprom, altogether the revenues increased more than 20%. So all of that was channeled into government spending. Even more and above, the government spending increased even more than that. So the non-oil deficit, non-oil and gas deficit, which is a more accurate measure of fiscal stimulus for an oil exporting and producing economy, the swing there was almost 3 percentage points of GDP. So Russia, if you look at the composition of whether it's GDP by expenditure or by composition of the industry, government spending was the most significant positive contributor. Following that, I have some doubts about the numbers, of course, as well. We see almost double-digit in some quarters investment growth, including private sector investment growth, and it was very strong throughout the year, including in the second quarter. So if I tell a group economist, so what do you expect private investment to be when you announce massive sanctions, there is self-sanctioning by foreign companies, there is huge uncertainty also, especially in the second quarter, and profits are going down more than 12%. Do you expect Russian corporates to continue investing actively? Well, you'd probably say no, I'd forecast some negative number there. No, but it was actually a rather strong positive number. The way Russian authorities explain it, they say, well, there was a carryover of these good projects that started, post-COVID, and they carried over into the rest of the year, and now they're winding down. But yes, it's still sort of a little bit doubtful. But again, government spending was extremely important in supporting the economy last year. And then finally, we shouldn't ignore the fact that Russian authorities have been battling crisis since 2008. There was significant, 2008 shock, then we had 14, then we had also COVID shock, and they've been increasingly preparing. We didn't know that they were preparing for a full-scale invasion of Ukraine, but they were trying to insulate and therefore isolate and also make their economy a bit more autarkic in some ways in order to prepare themselves for these geopolitical adventures. So this is an example where we need a cross-disciplinary approach of the sort of foreign security, defense, but also economics and foreign policy, how they interact together. Many analysts, including at times myself, we thought, well, because there is this liberal bloc of economists who are helping drive the economy and really are influential in Kremlin's thinking, that maybe that means actually Russia wants to go more liberal with time, or at least leaving itself that option to be more liberal. No, unfortunately, what it meant is that the geopolitical objective of aggressing a neighbor happened to be aligned with the macroeconomic prudence. So therefore, this sort of introduction of the fiscal policy rule, introduction of inflation targeting, cleaning up of the banking system, accumulation of reserves, I would even say excessive accumulation of reserves, was not meant because it was sort of going towards more liberal economics and therefore it might be more liberal society. No, it just happened to align with preparation for potentially aggressing the neighbor or war on the neighbor, where the Russian economy would be then better insulated and isolated from potential future sanctions that might have to experience. And in a way, it did have an effect here. Russian authorities managed to prevent a financial sector crisis, which many of us hoped would spill over into the sort of negative feedback loop between the financial sector crisis and the economy and would contribute to the economic contraction. So this is what happened and why in the Russian economy. Well, you would say, well, sanctions are working or not working. Well, I think expectations that Russian economy would collapse tomorrow, I think if anybody had those, were a bit unrealistic. But over the medium to long run, sanctions are hitting particularly where it hurts. If you think about long-term outlook for Russian economy, there's been a continuous revision to potential growth outlook for Russia. And you can look at potential whether by total factor productivity breakdown and extrapolation or filters, on the data, but it doesn't matter how you look at it. The potential has been falling steadily. And as one of the Russian authorities once joked, if I could put in negative potential growth into my macro models, I would. So potential now is maybe around 1% or lower. But if you think about the components, you think about labor supply, capital stock, and also productivity. If you look at the labor supply, there's been more than 1 million people, one could say 1.3 and above million people leaving Russia. And this is partially because of the war and partially because of the sanctions. So these people are leaving, because they're afraid of mobilization or they're not agreeing with the regime, or also because they're worried about potential growth in Russia. And there are opportunities in Russia, which of course are negatively affected by sanctions. These are oftentimes the highest educated and also in the prime labor group. Again, because they were having certain hopes for their own potential, and now these opportunities were removed. We have seen Russian authorities sort of swinging between threatening and warming up to, for example, IT specialists, a lot of industrial specialists, and even offering them cheap mortgages to stay in Russia, but they say thank you very much and they continue to leave. And these estimates come, from Rosstat, they also come from the local consulting companies, they also come from us. So there are also from the mirror statistics data from the countries that are receiving these people. So at least 1 million, but I would say 1.5 million have left last year because of the impact of the war and the sanctions. If you think about the capital stock in Russia, of course, you have to allow for massive depreciation of the old Soviet capital stock, so you also need to keep on running to just stay in place. Russia has historically had low investment to GDP ratios. Why? Because of the underlying problems with corruption, with unfriendly business climate, with worries about the even FDI investments. Last year, I know the government reported strong investment. I have doubt about that. But I would think that this year particularly, now corporates have definitely learned the message, but also they will not have this extraordinary oil and gas revenues, which have supported the economy via government spending and private sector spending. So again, investment will likely to be very low. And then if you look finally at the productivity growth, if you look at how Russia is integrated into the global value chains, of course, it's not Korea, it's not one of those highly sort of integrated and advanced countries. So if you compare to other, say, OECD countries, Russia will not be at the top. But at the same time, and there are many studies, including by us, but also other research institutes, showing that in the most advanced part of the Russian industry, where there are more sort of sophisticated parts of the industry, they're the ones that are most integrated. And they're the ones that now are struggling the most to access to the imports of the highly sort of sophisticated components. And that is also hurting their development domestically, but the ability to export as well. So therefore, sanctions are hurting particularly where there was a chance for diversification, where there was a chance for more advanced sort of structural transformation for Russian economy to become a bit more sophisticated and to move away from just extraction of oil and gas. And even in oil and gas sector, you see companies needing support of Western companies in order to do service or development of new projects. You're not going to be hearing about new LNG projects, and I'm so sure Steve will talk about that as well, because they need for that foreign company support. So the medium to long-term outlook is bleak, and sanctions are effective because they are sort of hitting on the pre-existing vulnerabilities. It's almost like, if you have asthma, it's much more dangerous for you to get COVID. So if you have pre-existing vulnerabilities in Russia, then you should, then for many reasons you should not invade a neighbor, but even from a very selfish reason, you shouldn't have invaded a neighbor, and therefore sanctions here were particularly sort of well thought through. But now the last point on so sanctions, how they can be revised and augmented, what are the most impactful sanctions that we could do? First answer, it's not easy. So we have more experience, and Jeff talked about it, about financial sector sanctions. We have experience of leading with financial sector sanctions. We know how to implement them, and also, especially authorities in the US know how to scare financial sector into complying. But even then, in early 2000s, mid-2000s, many financial sector companies were not getting the memo. They were still sort of on the wrong side of it. It took a few times, more than a few, of very heavy, sort of well-publicized fines before every single bank then invested into compliance officers units and have taken the financial sector implementation of sanctions extremely seriously. So now what we have to do, we have to lead with extraordinary export measures. One is this oil price cap, which some would say is a little bit like having a cake and eating it too. So it's by itself is a very challenging endeavor together with the embargo. And another one is export controls, which for the US, sort of US has played with export controls, and my colleagues here have done a lot of wonderful work on that. But US doesn't have absolute advantage in any specific technology. It has to have multilateral cooperation. And also technically implementation of export controls is extremely challenging because how do you identify this chip versus the other? How do you inform the customs officials across the world so that they will track it for you? Some of the BIS numbers, they're very technical, boring, but very important issues. It doesn't translate immediately into the trade nomenclature. It doesn't necessarily show up in the invoice that the bank sees in order to be able to monitor this export control. And then of course for European Union, it is even more challenging because European Union is the first time they're implementing this scale of export controls, and each individual member state is responsible for the implementation. So then, of course, the risk of uneven implementation is also there. And then finally, of course, we have pandas and others in the room, where if there is a direct relationship between China and Russia that Jeff was pointing towards, of course, there it's much harder for us to implement export controls. So with that, I will pass it on to Steve to tell us how to do better on the oil embargo and G7 oil price cap. Thank you so much.
Well, thanks very much. It's wonderful to be able to share this session with Jeff and Elina on such an important topic. And I'm going to try to do my best to complement what Jeff has said on the art, the statecraft of sanctions, and Elina's deep insights in the Russian economy. To say a few words about how sanctions are playing out in the oil market. So I have a few slides, and can they be shared on the screen? Okay, you'll have to. Okay, so so I'm going to talk about two aspects of. There we go. So talk about two aspects of sanctions in the energy market, in particular the oil market. So if you want to anticipate how actions or strategic gambits are going to play out in the oil market, you need to think both about what OPEC Plus are going to do in the context of the market, and how G7 EU sanctions are operating and influencing the market in that context. So let me just begin with a few basics about the oil market. And on the left-hand side of the slide, I'm sharing with you a stylized slide of the view of the oil market. So it has a rather unusual supply curve, that it's kind of a long flat bit, and then it's a steeply upward sloping bit to the supply curve. And the most effective tool that OPEC and OPEC Plus have in influencing the market is essentially to control access to relatively low-cost resources and to manage their contribution to the market. And they do this in a way to try to have the market essentially have demand and supply intersect on the steeply upward sloping bit. And there's a fair amount of evidence to suggest that this aspect of OPEC and OPEC Plus strategic behavior is effective. And then the other point that I want to emphasize about the structure of the oil market is that Saudi Arabia, Russia, and the other two key Middle East producers, the United Arab Emirates and Kuwait, have about collectively a 30% market share. And so if you think their objective is to undertake tactical or strategic actions in the oil market to boost their revenues, essentially they need to be able to operate on the demand curve that doesn't offset too much of their strategic restriction in supply. And so if you have about a 30% share of the market, as long as the demand elasticity of oil is greater than about 0.33, then you can temporarily at least restrict supply and increase your total revenues. And most of the econometric evidence around the structure of demand in the oil market suggests that it's about 0.1, 0.2 at the most. And so, at least in the short run, they can strategically manipulate supply and their revenues. But the important point here is that Saudi Arabia and Russia only have about a 10% market share on their own. So if they were to act individually, they couldn't really achieve their objective of controlling their revenues. And so they're kind of joined at the hip, given this market structure. And then the other point to realize about the oil market is that their capacity to act strategically is constrained by a much greater long-run elasticity of supply, a long-run elasticity of demand, and one that's growing. And there are also cartel issues. Next slide, please. Okay, thank you. Okay, thank you. So now, given that background and that context for the oil market, let me just briefly touch upon the recent strategic gambits that have been taken. The first was Russia's announced voluntary cut of its oil production by 500,000 barrels a day in February. And this was from a very kind of short-run peak supply of Russian oil production of around 11 million barrels a day. And this supply cut announcement elicited almost no market reaction because, in part, it was a cut from a temporarily very high level of production. And so this was more an apparent than real cut. It implies only a very modest reduction in total oil production for the year. The second development that occurred in the oil market was that over the course of the first quarter, the outlook for the market weakened significantly, and there was a growing market surplus, partly due to a slowish recovery in China, headwinds from the banking turmoils in the US and Europe, and supply increases, especially from those OPEC producers who operate outside of the quota framework. In particular, Libya and Nigeria have increased their oil production over the past half year or so by about 1 million barrels a day. Now, in early April, 5 of the main producers in OPEC, OPEC Plus, who were operating at their quota capacities, announced another 1.2 million barrel a day cut. And this did elicit a very strong market reaction. And that's because it was essentially a significant cut in supply into a weakening market. And that did elicit a very significant oil price response. But there are several kind of possible explanations around why this voluntary cut was taken. One is a rather kind of straightforward, that this was just supply and demand management by OPEC Plus in its normal way. Another was that it was a short squeeze on oil trades that had become particularly bearish after the banking turmoils unfolded. And other explanations are that it was, in a sense, a response for the delay in the US refilling the Strategic Petroleum Reserve, or possibly support for Russia. But if you look at kind of the market fundamentals, there's a fair amount of evidence to support the first explanation. So the chart on the right-hand side shows global oil market balances on a quarterly basis. The red line is demand, the blue line is supply, and the yellow bars at the bottom are market surpluses and deficits. And what you can see is from the second half of last year, the oil market had gone into surplus, and indeed in the first quarter of this year, it was on track to achieve about $1 million barrel a day surplus, and that has largely been reversed by the slightly over 1 million barrel a day cut by those selected OPEC members. And from this view of oil market balances, from a recent publication by the Oxford Institute for Energy Studies, these tactical cuts basically restore the market to approximate balance over the next year and a bit. Now, let me turn to the second bit of the second strategic gambits in the oil market. And these are the actions by the G7 and by the EU. As Elina and Jeff have mentioned, there's the G7 price cap that applies to seaborne exports of Russian oil. And this price cap was imposed at the same time as the EU embargo on its provision of shipping and related financial services to support as applied to Russian oil exports. And the key thing to realize here is that European providers of these shipping services and financial services hold a very significant share of the market for these services, particularly shipments in the Atlantic basin. And so this is a very key leverage point for the West. But there was a concern that an outright embargo on all EU shipping services would be a step too far and create too much of a tightening of the oil market. And so the price cap was imposed as a way of imposing a bit of a safety valve. And the price cap was basically put at a level that's broadly in line with the long-run marginal cost of supply of Russian oil. So Russian oil isn't necessarily as low cost as Middle East production, but there are significant but much of the long-run cost of producing Russian oil is $60 a barrel or less. And so this price cap has come in mostly to keep Russian oil in the market, to encourage its sustained production, but to prevent excess profits from flowing to it. And as others mentioned, this cap has largely been non-binding because of the very large discount on Urals, the Russian crude exports, at least until very recently. The other important action in the oil market was the decision by European countries and other countries participating in its sanction regime, essentially to stop its import of Russian crude oil and oil products, and essentially this creates a very big friction in the global oil market and raises the costs of Russian oil finding its market destinations. So the chart on the graph, the right-hand side of this graph, which is from the ECB, shows essentially seaborne Russian oil exports prior to the war to EU and other countries that are participating in the sanctions regime, and that's fallen quite dramatically, and at the same time, exports to Russia, Russian exports to Asia have increased significantly, especially to India. And so this has created a very large dislocation in the oil market. And one of the manifestations of this dislocation in the oil market is the very large discount on Russian oil, crude oil exports. So the chart on the left-hand side of this graph shows Brent oil price, which is the main international reference price for oil, as well, and then the two lower lines show the price for Urals crude, and then the red line shows the price line for the main Russian oil exports into the Pacific market. ESPO stands for East Siberian and Pacific Ocean price marker for Russian crude oil exports. And what you can see is that the Urals gap widened significantly. The gap between Brent and Urals widened very significantly, first from voluntary sanctioning by European importers, and then a wider formal sanctioning regime. And that's kept quite a significant pressure and gap on the difference between Brent and Urals. But Russian oil exports into the Pacific market are much lower share of the market, and it's been more effective in rebalancing those supplies. Now, where does this, how does all of this add up for the outlook for the oil market, for these two dominant types of strategic behavior in the oil market, on the side of OPEC Plus and on the side of the G7 and EU? And the first point that I want to make is that largely the oil market has been unmoved by all of these strategic gambits. The forward curve for the price of oil is on the right-hand side of this chart. The bottom line here shows the forward curve 6 months ago. The top line shows it a few days ago. And a lot's happened in those intervening 6 months, but the forward price for oil is barely shifted. And I would say that this is essentially a market reaffirmation of a few of the conclusions that I'm offering. One is that that OPEC is on course for the tactical management of supply and demand, but it's not out to fundamentally drive a level shift in the price of oil, and I'm not sure it has the power to do that. And then the other point that I want to emphasize is that the key Western leverage point in the energy market is really on making the market for Russian oil exports as inefficient as you possibly can without blocking them entirely. So you keep the global price level fixed, you essentially impose as high a tax on Russian oil exports as you possibly can, but inevitably you can anticipate that Russia will respond. And part of that response you can already see as it's moving into shipping and other related services, which is the key leverage point of the West. So I hope that is helpful in understanding a bit about what's going on in this context in the oil market. Yeah, thank you.
Okay, we've had 3 interesting and informative presentations, and while our speakers are getting settled in, I would like to ask the first question. As many of you know, I have this somewhat odd interest in North Korea. And North Korea is not Russia. I'm first to acknowledge that. But North Korea is an interesting case because it has been under sanctions of varying degrees of comprehensiveness for decades. And the economy is absolutely in terrible shape. Food insecurity is chronic, but the political regime appears to be fairly stable. And when you look at what is actually happening in North Korea, you see that the political regime uses the rents that are created by sanctions to reinforce political control. So you have goods that are under shortage, and the allocation of those goods is given over to key constituencies of the regime. There are opportunities for sanctions evasion, and so sanction evasion activities are controlled by key constituencies of the regime and so on. So my question for Elina would be, what are the allocative mechanisms in Russia? There are presumably shortages of what had been earlier freely imported goods. Does the market just allocate this? Is there some system of quotas? Are people given monopoly rights to import? Does the Russian regime use these rents that are created by sanctions? You had mentioned they're somewhat non-transparent excess profit tax as a way to soak up revenue. But are there other mechanisms that the regime uses that are created by sanctions to reinforce its own power and control, even though the economy may be shrinking, as you observed?
Thank you so much. I think it's a critical question, and that's why I've had some analysts say, is it going to be North Korea or is it going to be South Africa version of sanctions? And the issue here is that it doesn't seem that we're at the North Korea stage. So if you look at the contraction in imports in the Russian economy, there's been a dramatic contraction in the second quarter, and then it's pretty much normalized by the end of the year. The actual contraction, especially in volumes, is not that significant for the end of the year. The reason being partially was, of course, contraction in domestic demand, but also there was lack of supply of the goods that people wanted. By the end of the year, you see a lot of replacement via third countries of some of the goods that they would like to have. Yes, there are certain visible things that are missing, certain types of cosmetics, or partially because of self-sanctioning, not just export controls. But it seems that China, Turkey, UAE, a range of countries have stepped in to help them access these products. There was also arguments that, look, but this is at much higher prices. Yes, prices are higher, but I wouldn't say, and we're beginning to do work on that with colleagues here, of trying to disentangle volume versus price effect, particularly for China, but I wouldn't say that the prices are extraordinary or times over of what otherwise would have been. So I think here we need to probably squeeze more, and because there is still a lot of access to this export-controlled goods. On the oil price cap, indeed, I think what we see as an Urals gap and therefore lack of revenues for the budget from these direct taxes, some of that money is with the oil and energy majors. And they are potentially using it for a very intransparent way for the regime still, because these are state-controlled companies. But this is their way of getting extra slush funds that we might not have direct access to or transparency over.
Thank you. And before I open it up to the floor for questions, I have a narrow question for Steve. In your, I think, the penultimate slide, you mentioned a carve-out for oil from Sakhalin for Japan, and it was somehow connected to access to LNG. Could you just explain what that is?
Yes, in the G7 sanctions regime, there's an explicit carve-out for Japan on its oil imports from Sakhalin. The technical issue associated with this is that Sakhalin facility is primarily for producing liquefied natural gas, but as is often the case in the industry, if you produce natural gas, you also produce a bit of oil. And if you can't move the oil on, you put the LNG production at risk. And so the context for this waiver that allows relatively small imports of Sakhalin oil into Japan is the justification for that was essentially an energy security justification for keeping the flow of LNG from Sakhalin going. The oil is small, the LNG from that facility is material. So that was the context.
Thank you. At this point, I would like to open it up for questions from the audience. I apologize for people watching this online. Hopefully, in a future meeting, we will have the technology so that we can make this truly hybrid and have people online submitting questions as well. But please identify yourself and your affiliation.
Adnan Mazari, Peterson Institute. Two questions. The first on banking sanctions. Aside from better enforcement of sanctions that have been put on the books, what more could be done in that area? Second question is about import substitution. Since 2014 invasion of Ukraine, the first round, Russia put in place some form of import substitution policies, which apparently were not very successful. If panel members have a view on that, I would appreciate it. Thank you.
So who would like to take that?
Maybe I'll start on banking and the other one. So on banking, we have three key issues. One, we have the existing reserves which were mobilized. The second one is the new flow of reserves, which are in transparent, sort of the slush fund that we're not quite seeing. And then the third one, the rest of the banking system. So on the reserves that are mobilized, I'm not a lawyer, so I'm not going to get into that discussion, but I think it would be important for credibility to have reporting on what was immobilized and where it is and how we can assure ourselves that it hasn't moved. You know, the fact that government officials tell us that, yes, it's fine, but I think we as an independent analyst would like to be able to check. So I think that will be extremely important. On the new flow of reserves, we have seen the 230 plus billion current account surplus, which went somewhere. It seems to have, at least according to Russian balance of payment statistics, went half into repayment of external liabilities, half into accumulation of assets by Russian banks and corporates. As we know from the Russian financial capital account, it's the repayment of liabilities can be also a very obscure category. It could also be transactions between the two Russian companies just registered abroad. So there is potentially this slush fund that maybe is partially with the oil producing companies and partially with Russian banks that we might want to keep an eye on, because this is almost back to if the countries against the war mobilize 300 billion and they've accumulated another 200 plus, you know, that sort of neutralizes it. Then finally, on the banking system, and my colleague here, Nicola Veron, has done a lot of work on that, there is the argument of saying that, look, you know, why don't we have all of the banks under, because one way or the other, they are connected to the regime, and then we'll only exclude certain transactions. Of course, there are some legal arguments why European Union might find difficult to do that, because you need to have legal backing and evidence why you're excluding any specific bank, and then you exclude that bank. At this stage, we probably sanctioned more than 75% of the banking system in Russia. There is also, and you worked a lot on sanctions on Iran, there is also a question, you want to prevent these transactions from going through, but at the same time, you want to have some sort of visibility. So of course, this, I'm going to say something controversial, but this swifting at that time was important because there was a hope it would trigger, together with other measures, financial sector crisis, and there was some dramatic withdrawals, including from Sberbank of the liquidity, as we know, but then it was stabilized. But at the same time, then you lose a lot of visibility on the transactions that are happening. So I think there is also that balance, especially related to the second point of the flow of new money.
Go ahead, Rachel.
Oh, sorry. Rachel Ziemba, Center for New American Security and Horizon Engage. Thank you for a great discussion. I wanted to pick up on this sort of financial piece, but apply it to other sectors. Elina, and I think Jeff Jeffrey as well, you sort of highlight this element of the sort of shift in shift towards autarkic nature. But I'm interested in your thoughts about the kind of shifts in rents outside of Russia, right? I mean, it came up a bit in Stephen's presentation as well. This question mark of creating the supply, creating the oil price cap. This sort of diversion has meant a lot long, sort of shift to seaborne oil, a lot longer sort of journeys and the like. And I'm wondering about, I guess my specific question to Elina is, have you seen any evidence that the intermediaries, say, involved in, whether it's in the UAE or elsewhere, some of which are Russian, that money is getting back to the budget? I mean, there's an element, maybe that's not yet, but in this enforcement environment, I think the US government has sort of been a little bit blasé about the sort of potential shifts of away from G7 services and more focused on we really just care about revenues not getting back. But I'm just interested in your thought there. The other just comment is that
we're running low on time. Yeah. So before you answer these specific questions, what I would like you to do is say anything you would like to address the questions, and then any final thoughts that you have about anything else that has transpired, because we're getting close to the closing time.
So maybe I'll talk quickly about the price cap and this offshore. I think on offshore, sort of the Enablers Act and also in legislative initiative in the UK, I think it's extremely important because, as we know from Panama Papers, for example, information and other leaks, is that ends up with the Western financial systems in the offshore, and it's often facilitated by the Western consultants, asset managers, and so forth. So I think that is extremely important also to look inwards, not only just in Russia. On the price cap specifically, as you saw, OFAC made the mention, they're aware of the studies that, especially from Cosmino, the ships are going and insurance is going with above the price cap, and Steve talked about it. I think auditing attestations, collecting them on one place, auditing them, and also making them available to the extent possible, of course, confidential, company keeping that in mind, for us independent analysts to study, that's extremely important, because we're also seeing evidence of shipments above the price cap that are facilitated by G7 providers. And then the closing remarks, I think I'll do that. The import substitution one is indeed, there's been some import substitution in agriculture, but at the time, Russia still had access to Western technology. John Deere combiners are the most important ones for Russian agriculture. So import substitution without foreign know-how, I think it still will be limited.
Say more on the oil.
Okay, just to follow up on the price cap, I think it's fundamentally important to look at the price cap regime together with the other sanctions that are putting huge frictions into the oil market. And that's fundamental, that the fundamental point here is that they work well and effectively together, and to make the market as inefficient as you possibly can make it for Russian oil exports while keeping them in the market. And if there are providers, Western providers of services, shipping services to Russian entities in breach of the cap, it's important to continue to put pressure on to enforce the regime and to force more of these exports of Russian oil into less efficient transit routes, less efficient services, while still keeping them in the market. So it's a question of calibrating and tightening the regime, but in a sensible way.
Yeah, essentially, the price cap is set on an FOB price. And so any additional costs in distribution, transport, are going to come out of the profits or be siphoned around and end up in a slush fund somewhere offshore. So Elina's points about the slush funds and greater transparency of those funds is important. That would be where you want to see more attention and efforts made. And I believe the U.S. Treasury is doing that and has been for the last couple of months. The issue of import substitution that Adnan raised before, that is essentially a national security tax under these circumstances. And so it is making it more costly and cumbersome to do business. And so adding to, over time, the corrosive impact on productivity in the Russian economy. In terms of the legal aspects, if you're engaged in a war and you invoke national security exemptions from the trading regime, all bets are off. It's interesting that there isn't a long history of litigation in the World Trade Organization on the national security exemption that exists in the trading rules. The last case that was adjudicated was between Russia and Ukraine. And Russia won, and Ukraine didn't appeal. But that's now in the realm of ancient history. Thank you.
Well, we have reached our closing time. They say that you should, quit leaving them wanting more. We've heard a lot of interesting analysis, and I didn't get to ask my question about the impact of seizing Russian central bank reserves on dollar dominance, so I, for one, want more. Please join me in thanking Stephen Fries, Elina Ribakova, and Jeff Schott. And with that, I will declare session adjourned. Thank you.
Indeed, indeed. Nicely complementary. Yes. So different aspects of the yes.
Oh, good.